It's my pleasure to welcome Mr. Lars Kroijer to the Meaningful Money podcast. Lars, welcome. How are you doing, sir?
Good. Thanks for having me. I'm excited to be on.
Yeah, it's great to have you. And this came about because of a mutual friend of ours, Matt Powell. Matt is a listener to the podcast. Matt came to my meetup in London last November and shared a pint or two with me, and has become a good friend and contact. And he gave me your book, Lars, which was very kind of him, and I've read it and enjoyed it. And so when he offered us to put us in touch, I bit his hand off. So it's great to have you. Let's kick off, if we can, just with a bit of a bio, who you are, where you've come from and how you ended up doing what you're doing now.
Okay. Well, I'm old enough that my bio has gotten pretty long. So I'm originally from Denmark, but I haven't lived there since 1990. So that gives you an idea of how old I am. I lived in the US for 10 years where I did all my university, and I worked on Wall Street at an investment bank. Then after university, I went and joined a hedge fund in New York, but very soon after moved to London, joined another hedge fund, and in 2002 I set up my own fund. So did that for a while until incredibly fortuitously in early '08 I returned capital to the external investors and essentially continued with my own money. Okay. Since then, I still sit on the board of a number of hedge funds, and you know about one of them, but I've written a couple of books about finance.
Yes.
And so that's really my background in this field.
Yes, that's. I'm going to come back to the hedge fund thing later. It's the book specifically that Matt gave me, and yes, what's the other one called? This one is Investing Demystified. What's the other book called?
The first. So I've written two full, and then part of a third. I'm a part of a third one, but the first one's called Money Mavericks, and it's essentially a book that describes my journey in as starting and running a hedge fund, how that came about, and all the defeats and the victories, and really trying to explain what that world was. And I always felt that, not to bore your listener with another topic, but I always felt that the hedge fund world was a misunderstood one. That most of the literature out there was about the Bernie Madoffs of the world that had cheated people out of billions, or about George Soros that had made billions, typically at the expense of someone else, all while flying private jets and driving Ferraris. And I felt that was not the world I'd been a part of, but also that world was not unexciting, that it was a tremendously interesting world. And so I felt I had a pretty unique opportunity to write a book in the first person, saying, well, what was it like being me? And we did very well, but we started, had very humble beginnings. So, which is funny because I've later learned that that's the bit of the book that people like the most, is when we were doing really shit. And we're being humbled on a daily basis. That's much more fun than the good stuff. So,
it says something about human psyche, doesn't it? That
I'm a hedge fund manager from a good family, so no one's ever going to feel too sorry for me.
So tell me about Investing Demystified. What was the trigger for this? Why did you feel like you wanted or had to write it?
Yeah, the very practical trigger was that the first book ended up doing really well. Mm-hmm. And so my publisher came back, Financial Times, came back and said, we'd like you to write another book. And I didn't want to be like the hedge fund guy. I didn't think that was, but I didn't want to write another version of the first one. And so the topic in the second book is actually something that's throughout my adult life been very close to my heart. And I thought, well, just because I ran a hedge fund, it's not in any way inconsistent with the message of the second book. And so it's actually originally I thought of, instead of going into investment banking, I thought of getting a PhD and teaching this stuff. So that was actually but then I had a ton of debt, and they offered a lot of money, and so I sold my soul. Right? but I've always felt that the idea of investing and knowing whether you can beat the market or not, and what you should do as a consequence of not being able to beat the market, is not only a theoretically very interesting topic, but it's actually one with extraordinarily far-reaching practical implications. And I thought, here I had, the knowledge, and I had the background, and the platform. I had a publisher who wanted to let me write a book, right? So I thought that was pretty cool, actually. It was a pretty unique opportunity, and no one directed me to, what I should and shouldn't write. So
excellent.
So that's how it came about.
Free reign.
It's funny to have to explain the publisher back in the day how it was different from some of the other, call it index-oriented books, because it is different. I can talk to that.
Yeah, I would like you to talk to that, because you mentioned there that the approach to investing that you talk about in Investing Demystified, it was not sort of incompatible, I can't remember the exact word you just used, with your background as a hedge fund manager, which is obviously a very different kind of approach. So how do you go from one to the other? And yeah, if you can just speak into it's not really a transition, because you say they're sort of...
Right.
Yeah.
No, I often get accused of being a hypocrite. So
no, I'm not calling you that.
Well, what is it they say? A double standard is twice as good as a standard. No, but look, okay, so I think, where should you start, right? You should start by who are you? And you should start by making it clear in your own head whether you can outperform the markets or not. Can you beat the markets, right? Now, because you can or cannot doesn't mean that markets can or cannot. It's a huge leap, right? So I often think of my mom, which is a little unfair, right? Can my mom outperform the many, many brilliant investors I've come across in my time that all have better access to information, to management, to technology, to even all the accounting stuff, and time? They do it for a living. And the answer is she doesn't have a shot in hell. So let's accept that. And I go through in the book, because I've been on the other side of that. What is it actually that all these investors do and know and have insights into before they buy or sell a share? And it's an awful lot of work, and some of it extremely intricate. And even then, it's not always clear that they can beat the markets. So compare that to someone sitting in their boxer shorts in front of one of these, E-Trade accounts. It's just not an even match. So that's point one. Just because you cannot doesn't mean that markets cannot. So when I was running a hedge fund, I was very much of the view that we could. We had the best minds in finance working with us. We had fantastic investors. We had fantastic access to information and technology, and management teams wanted to talk to us and engage with us, and even sometimes listen to us. Not always, but sometimes. And so if we couldn't beat the markets, what are the chances my mom can? Nil. Well, she might, but it would be luck. Right? You never want to depend on luck. So that's point one. Point two is then, well, shouldn't my mom just give her money to someone like me, or some version of me? And there are thousands, Lars, many more, but there are many, many Larses out there, guys wearing khaki pants and a nice tie. And so you got to look at the statistics and say, let's ignore hedge funds for a second, because that's a little more intricate, who can and cannot invest in this. But let's say mutual funds, so the ones you see advertisements on the high street, right? Fidelity of the world. And things have changed a little bit. But if you take it from a statistical perspective and say, let's say you buy access to the FTSE through one of these mutual funds. And statistically speaking, historically, the chances that one mutual fund outperforms the index that it's trying to outperform over a 10-year period is about 10 to 15%, give or take. Who knows? You can always find statistics saying whatever you want it to say. So call it 1 in 10. Or call it 1 in 5 to be extraordinarily generous. Well, then the next question is, my mom would have to ask herself is, okay, so I know I can't find out better than the world if Facebook is going to go up or down in value. But I also have to pick the 1 out of 5 investment professionals that all look good, and they all went to the right schools, and they all worked at the right places, and they all have the right teams and the great ads and great track record. And I have to pick 1 out of 5 of those in order for it to beat the market or beat the index.
Those are not great odds.
That's terrible, right? So again, so you can beat the market by individual stock selection. We can talk about other security classes, by the way. Now we're sort of talking equities, but it applies broadly. So you can't beat by individual stock selection, and you can't beat the market by manager selection, i.e., which of the better looking khaki dressed investor. And so don't. Now, so then the next question my mom sits back with is, should you invest? Like, I've now learned that I know nothing, right? Mm-hmm. and the answer to that is absolutely you should, because if you don't invest, what are you going to do with your money? Put them in the bank and earn 0%? What? I mean, that's a choice, right?
Yeah.
And sometimes you should do that. But historically, and there are no predictors of future performance of equity markets. If anyone tells you otherwise, they're wrong. But if you take the sort of slightly academic approach and you say, well, historically, across all markets, also the one that went bust and also the one that went well, over the last, call it 250, 100 years of history, mm-hmm. equity markets have returned somewhere around 4 to 5% above inflation. So if you start by saying, well, for a similar risk, it's not unreasonable that you can expect a similar return. So who knows? Yeah. And anyone will tell you equity markets can go anywhere, and they really can. Mm-hmm. But if you say that for a similar risk to the one you endured in the past, you can expect a similar return, that's not insane. And that's 4 to 5% for historical equity market risks. Mm. And that's why you should invest, because that you can reasonably hope, but with huge variability. So anyhow, I'm talking too much.
No, not at all. That's why you're here, mate. That's absolutely fine. It's an absolute delight to listen to you. I mean, I absolutely resonate, obviously, with everything you said. It's what I sort of preach to my limited extent. I don't have anything like your level of experience or expertise in the area, but as a financial planner, I'm not an investment manager. But unlike a lot of financial advisors, I know I'm not an investment manager, right? A lot of them.
Well, honestly, I think that's the way the industry is heading.
Yeah, me too.
Just because you can't beat the markets doesn't mean you're not adding a lot of value. Mm. In fact, I get emails every day from readers, and they're very often of the variety. I have X pounds, dollars, mm-hmm. euros, krona, whatever. Well, can you help me invest it? And I'm always like, that's not what I do. But if you believe the message that I'm writing, at least you know what to invest in.
Yes.
That doesn't mean I can help you with taxes or estate planning, or even like someone to help you through tough times.
Yeah.
Or how do you think about the interaction between your job, your house, the jurisdiction you live in, all that stuff. I think there's a lot of room for financial planners, and it becomes a different role once you're not in the position to say, oh, you should buy Facebook.
Yeah, absolutely. Yeah, I totally agree with that. If you were to sort of summarize, you call the portfolio sort of makeup that you talk about in the book, you call it the rational.
Right, very unexciting. Right?
Yeah, well, no, but it's evocative. So can you just speak to that, what you mean by that, and essentially how you construct a rational portfolio?
Yeah. So the term, the rational, it's a bit of a grandiose term, really, I accept that. It's the idea that once you get past the acceptance and embracing of the fact that you can't beat the markets, this is the rational thing to do.
Okay.
That's what it is. Okay. So what is the rational thing to do? Well, let's start with equity markets, and then we'll go from there. So I'm saying you can't beat the markets. So what does that mean? It means you can't pick which stocks are going to go up or down relative to the market. But as we talked about earlier, you should invest in the markets because you're hoping to get a 4 or 5% annual return above inflation with big risk. Okay. So what is the market? Well, there's a temptation, we're both in the UK right now, so there's a temptation to say, well, that's the UK. But there are actually very good reasons not to invest in the UK, or certainly not only to invest in the UK. So let's compare the UK market to the Brazilian market, or the US market, or the Australian market. There's no reason to think that the UK market, that you as an investor who's accepted you can't beat the market, there's no reason to think that you know better or worse whether the UK market will do better or worse than any of those other countries I just mentioned. In fact, if you had that knowledge, that would be extraordinarily valuable knowledge.
Go get rich if you do.
In everything I say, there's sort of the, go get rich if you think I'm wrong. Mm-hmm. Don't forget us little people when you're done. But I think there's so what you should do is you should diversify as broadly as you possibly can to avoid taking individual country risk, individual jurisdiction risk, And you should certainly, if you only do one market, don't do your own, because that market is typically correlated to all your other assets, your job, your education, your house, anything ties back to the local economy. And so what I'm saying is, for equities, you can actually just buy one product. And that one product is a global stock index. So there are many variations of it, many providers, including Vanguard and BlackRock, and one is called MSCI One Index. Vanguard had their own, but they're all very, very similar. And what they're trying to do is to give you the broadest, cheapest exposure you can get. So buy a global tracker. Every stock in the world, theoretically speaking, we can go into details of why it doesn't work that way, but close enough, right? Mm-hmm. So now for your equity portion, think of it as if you have an index that covers the global stock market in the proportions to the value of that market. So in other words, the most valuable company today, I don't know what it's, Apple or Amazon or something like that, has a greater proportion than some small company in the US, because it's a bigger part of that index, which makes sense, because what you're saying when you're saying you can't beat the market is you're saying, I'm assuming that every dollar invested in the market is equally clever, and that I'm not more clever than any one of those dollars. So if the market is saying that Microsoft is worth 100 and a small stock is worth 2, well, those $2 and those $100 are equally clever, or I'm not cleverer than either of them. And so therefore, I should own $100 worth of one and $2 worth of the other. That's what it's called a market cap weighted index. Mm-hmm. So for equities, that's what you should do. Just do that. Make sure you do it cheap. Make sure you tax optimize, and that's where you'll come in. Mm-hmm. And that means something different to different people. And I don't really get involved with that because it's so, it's unique to the individual. Think about liquidity, although these are extraordinarily liquid products. But now that's equities. You're done. You are done. If you invest in equities, that's all you need to do, in my view. And I've yet to have anyone convince me of otherwise, and a lot of people have tried.
I'm with you. Yeah.
And so, okay, so there's some nuances around there we can come back to. But that, if you do that, in my view, you're doing better than anyone you know. Okay, assuming that you don't think you can beat the market. So now you have a portfolio of, let's say 100, and it's invested in equities. You now know what to do. But what if the risk of the equity markets is not your risk profile? Mm-hmm. Now, your risk profile is a very, very individual thing, right? If you're down to your last £1,000 and you're about to retire, well, don't take a lot of risk. Or the terrible analogy I use is, if you have £100 and you need 95 for a heart surgery next year, then don't invest in equity markets. Because you might on average do better, but you can also go horribly wrong. So you now have your equity portfolio, but it's not clear that that's all you should invest in. In fact, very often it's not. So how you can combine that with something that gives you the kind of risk that you need. So now we're in the UK as a great example, because the UK actually has a super low risk alternative, namely the UK government bonds. Mm-hmm. Okay, not every currency has that, but your currency and mine, well, not mine, but your currency will have that. And so let's say your investment horizon is 10 years. Well, you can buy a 10-year government bond, or you can buy ETFs that does that for you. And you can combine that with the equity investment. So let's say your risk profile is such that for half your portfolio you want to take no risk, and for the other half you could take equity risk. Well, you buy 50-50. So imagine you have super low risk but also no return, and super high risk but also high returns. And how much you should invest of the two of them depends on you. If you're very risk loving, do a lot of equity. If you're very risk averse, do a lot of the bond. Mm-hmm. And you have two products here. That's it.
Nice and simple.
You're done. You are done. And you can add complexity around this corporate bonds. Sure, but it doesn't add as much as you'd think. You can add other government bonds and say, well, I don't believe in the credit worth in the UK. Sure, but then you start taking currency risk. Right? That's why a lot of people use U.S. bonds, but you're taking dollar risk, and not at necessarily at a better credit rating either. But this portfolio I'm talking about is stunningly simple. Right? You have 2 products, and you're done. Think about your risk, think about your tax, but you're done. And that's it. If you had another currency, let's say we were having this conversation in Brazil, you would be forced to make the choice of, do you want to take credit risk with the Brazilian government, currency risk with a call it risk-free investment in something like UK, Euro, German government bonds, or US AAA rated government bonds. But you take currency
risk. So how come then, with the equity side, you're getting the diversification by tracking global markets, essentially?
Yeah.
Why not do that on the bond side? Why not be a little bit more diversified? I hesitate to use the word conventional wisdom, because very often that's a tautology, right? Not tautology, oxymoron. That's generally convention is not wise very often, right?
Yeah.
But conventional wisdom might be to diversify the bond bit as well. Yeah. So I'm just interested on your view on that and why.
Well, no, you certainly. I mean, look. What are you trying to do with a bond portfolio? You're trying to not lose money.
That's the question, isn't it? Yeah. What is it for? Is it just a volatility dilution thing?
I mean, I'm sure, if you're a great, and you could make an argument, but you're making the portfolio very complex, because it's also not easy to buy a lot of these products. If I told you now, go buy government bonds from Brazil, Mexico, and Vietnam, you'd be like, ooh. Oh, wait a minute.
Yeah, how do I do that exactly?
And tell me this, in which proportions? Yeah. In the proportions that they're issued, in the proportion of the indebtedness of those countries, in the proportion of the GDPs. So you can see all of a sudden you're like a bond investor.
Right? Yeah, exactly.
And then, so I'm not, you just, it's the same argument with corporate bonds. You can go that route. And if you very quickly, deliberately or inadvertently, end up back at having claimed that you know something the world doesn't.
Yeah. Okay.
Or you're adding a ton of complexity, or implicitly both.
Yeah.
And so that's why I'm saying 95, you can, if you and I were together running the world's largest pension fund, yeah, you should probably do more stuff than these 2 simple products I'm describing. Right. But I would say for 95% of retail and even wholesale investors, mind you, there are big pension funds that are doing just this.
Yeah.
And I'll tell you, 2 of the biggest savings people never think about is, one, it's actually time. Right? So when I get emails from people, about half the time, they're like, wow, I didn't realize where all this time came from. I used to stress so much about which stocks, and I used to buy the Financial Times and religiously read about quarterly results. And now I just know I have this index, and it might go down, but at least I'm not spending the time. And on average, I will probably do better. And so the time component is a huge one, but the biggest one is the cost component. And in the book, I use an example, and it's sort of from real life, actually. But if you take the scenario of someone who starts working as driving a train on the London Underground, and from the ages of 25 until, I think it's 67, and that he or she makes $50,000 a year on average, and that goes up by inflation. And let's say, and ignore tax, which you certainly shouldn't, but let's ignore tax for a second. But let's say that person puts 10% of the annual income aside in equities every year, and that his or her salary goes up with inflation. At retirement, let's say 2 scenarios. One, invested in a regular mutual fund that try to pick the market with all the fees and expenses and marketing associated with that, and the other invested in an index tracker. And let's just say that before fees, this mutual fund did like the market, which is sort of what you'd expect. And let's just say that equity markets did like they have in the past, no better or worse. Right? So I think I used 4.5%, but don't hold me to that. The difference in savings at retirement, so part 1, mutual fund, part 2, an index tracker, is the equivalent of 6 Porsche cars. So this is someone driving the train on the London Underground throughout his career who could probably never afford a Porsche car, has paid over his lifetime or her lifetime the equivalent of 6 Porsche cars in fees and expenses.
Yeah.
That better be a good reason for that, right? That better be a good reason for that. So that just puts, like, this is not a small topic.
No.
It's a big topic.
Absolutely right. You're dead right, and it's I think there's a real squeeze on costs now, which is healthy. I think regulators, at all levels, whether it's asset managers or platform admin system providers or financial advisors, and there is a squeeze, and that can only be in investors' best interest, which is good. Just want to sort of stay on the bond thing, just because I get this sort of spoken at me by investment managers all the time, in the sort of commentary that, we've had, quotes, a 30-year bull run in bonds, in bond prices, and there's no value in bonds. It's really hard to find value. I just wonder what you sort of would say to that, given that there's a minimal risk asset. You're saying is government bonds ideally in your own jurisdiction if it's good, if there's sort of good credit risk there. Is it not possible that we're buying a loss there, or are we actually talking about buying the individual bonds at par, or what? You can just sort of speak a little bit to that.
I mean, keep in mind, in all of this, I've actually never said that I think I know which way the markets are going.
No, that's true.
Right, and that's a key premise, because otherwise I'm breaking my own premise.
Yeah.
So, let's say you're buying a 10-year bond, and let's say interest rates go up, right? Real interest rate go up. The value of that bond will go down. Of course it will. But let's, consider the alternatives. What are you going to do with that money that you want to take no risk with? What do you want to do with it? Are you going to put it under your bed? Are you going to buy gold, which, by the way, is extraordinarily volatile?
Exactly.
Are you going to buy property? Well, you're probably, I don't know you, but most people are massively overinvested in property, which, again, by the way, correlates with your job, your economy, et cetera, et cetera. Most people are massively invested in property. Don't go buy more, certainly not down the street from where you live. You're adding to correlation. And in the UK, there's a tendency to think that's a great idea because it's work. But go ask people in Florida or Las Vegas how it worked for them.
Sure.
Correlation risk is one of the most underappreciated risks in the financial sector. But so I'm not saying that it's minimal risk. It's not no risk. Why is it minimal risk? Because if you buy, let's say, a 0 coupon 10-year bond, and it's going to give you 110 year, let's even somehow manage to inflation adjust it, then you know that in 10 years you will get 100. That's all you know, right? Will it in the meantime, interest rate mean that bond goes up or down in value? Maybe. But the shorter date the bonds, the less interest rate will impact the value of the bonds. Right?
Exactly.
But maybe also turn it on its head. All those guys that come and say you're buying at the peak of the bond market, well, go short it and make money.
Exactly.
Right?
They've no idea whether we're at the top of the market or not. None of us do.
Yeah, I don't know the people, so I certainly don't know, right? But they're, I think it's been 5 years now that I've heard of hedge funds shorting Japanese government bonds because they can certainly only go down, and all that's happened is they're now 5 years older.
Yeah, exactly.
So again, it's a pretty big statement. I mean, the global government bond market is a multi-trillion-dollar market filled with really well-informed economists all over the world buying and selling all day. And someone makes a throwaway comment that it's reached the peak. Pretty bold statement.
It is.
And it's certainly not one I would advise my mom to make.
Yeah, no, exactly. It's so easy to throw away this stuff. I'm thinking, I'm already second guessing myself. I'm sure I've said that. I may even have said that on the podcast. That's really bad. So I sort of resolve now to be more careful about what I say in future.
Another thing that happens is we all tend to remember our victories, right?
Yeah, sure.
We all tend to remember when we were right. And I actually think a huge problem in investing is let's say you go to a dinner party tonight and you're sitting around the table and you made money in Google, some people would love to tell that story because it has all this sort of, oh, I'm so smart, I'm so insightful, I'm so full of this, I'm an investor, I have money, all of that. And maybe they're just lucky.
Yeah.
Right?
Yeah.
Who knows? Maybe they're just lucky. They certainly don't think so, because people who make money in the stock markets never think they're lucky, right? Otherwise, exactly. They should do what I'm saying.
Yeah.
Now, let's say there's a person sitting next to that person who had done exactly the same betting on horses. Most people around the table go like, ooh, that's not, you shouldn't bet on horses. You're going to lose money, right? So there's this in investing, there's this sort of, oh, you're a player. You're smart. You're astute. You're good with money. Right? And so therefore, there's the conventional wisdom certainly encourages us to have an opinion. And I'm saying don't have an opinion, except you don't, which I guess it is an opinion in itself. But but so it can be hard, which I actually sometimes think it's almost an emotional argument that you have to believe like that it's okay. You have to believe that you're actually more informed by accepting where you should and shouldn't play.
So you mentioned the word emotion, so that's a behavior thing. So I mean, behavioral finance, behavioral economics is a subject that fascinates me. Long-time listeners of the show know that. I've dealt with it in and out now and again. My good friend Andy Hart of Maven Money, he's a real sort of zealot for behavioral finance and speaks a lot into that. I wonder what your experience of that is, as somebody who has invested other people's money as well as your own. Mistakes people have made, and what people can do perhaps to improve their chances, of or rather reduce the chances of falling foul to bad behavior.
Well, I would say it's a huge tendency to say read something in The Economist or the FT or somewhere and go trade, go do something, because it even feels good to do something, right? And there's this day and age, it doesn't cost a lot to trade, right? So it seems cheap. But a lot of people that do that will over time do significantly worse. Right? They will just, forgetting the time that it takes, but there are tax implications, there are bid offer spreads. Very often on the platforms, you certainly don't get very good execution. There is commission. And I think so don't do that. Don't, just
Stop
leave it alone. Don't think because X has happened in the market, the market better. There's also a tendency, like markets have done so well, so they will continue to go up. That actually happens professionally too. Investors that have done so well will clearly do better. Or, people panicking at the bottom and saying, oh, it's going to all go to hell now. Right? So stay consistent in your belief that you can't beat the market, even after X has happened. The other thing I think is important is that just because, well, all right, so let me take a step back. So what can happen that makes sense is you can change your risk profile. Let's say that you invested all in equities, and this is a terrible example that I hope should happen to no one, but that you don't think very hard about your risk. And let's say you invest in 100 in equities, and equity market's half. You might think, shit, I was greedy. I cannot afford for this to fall anymore. Because then I'd have to, also, let's just say all sorts of bad things are going to happen in your life. You might actually find yourself forced to sell at a huge loss. Not because you think markets are going to fall any further, because you accept that you don't know that and markets can bounce back. But because your circumstances are such that you're a forced seller. And that, unfortunately, is something that happens a lot in down markets, right? And, some people double down, but that's a bit like going to a casino. That game where you play on red and it comes up black, and you double them out and you play on red. That game actually really works until it really, really doesn't work.
Yeah, absolutely.
That's what doubling down in the market is like, right? So I think, to be very aware of that. And I do think, but it's a pet thing of mine. No one ever listens to me. That's true very often, by the way. But I think people don't think enough about correlation risk. And what I mean by correlation risk is, I forget the example I have in my book, but it was a real person actually, who was living in London. She worked in real estate. She's a real estate broker, had most of her money in a London house, and was going to inherit her parents' place. That was also a London property, lot of mortgage, and then had some savings and had a certificate, an education in this space in London, and was working for her London firm, and had some insurance policies that were also very local. And then the savings she had, she wanted to invest it in London property stocks. So she's extremely long London.
Yeah.
Right? So this is before Brexit and all that stuff. But like that's just don't, right?
Yeah.
I mean, if London does well, she'll be fine, right? If London does crap, all the things go pear-shaped at the same time for the same reason. That's correlation risk. And there are all sorts of ways that manifest itself. And it's actually more and more important as the world has gotten more interlinked.
Yeah. One example I come across quite often is people who own shares in the company they work for. So the share safe schemes. I had one client who had £180,000 worth of cable and wireless shares. He'd worked for them all his life, all around the world. And they went down to 8. And it's just,
and sometimes people don't have a choice.
No, sure.
Or the tax advantages are so huge that,
Yeah, there's reasons.
So that's one thing. The other thing is think a little bit about, your pension, who guarantees it? Is it, are there sort of correlation risks like the ones you talk about there? Very often there aren't in the UK, but elsewhere that's a real issue because it's guaranteed by the government. Just like you don't worry about deposits in your bank, and the reason it's not really a topic of conversation is because it's guaranteed by the government. But there are places where these are real issues.
Yeah, sure.
So there are these things that I think people don't think about enough. But I'd more say the central theme to my book, if I could just make people think a little bit more about whether they can beat the markets or not, I would.
That's definitely the prevailing message.
A lot of the other stuff will follow.
Yeah, right? For sure. You mentioned ETFs a couple of times. Most folks listening to this will know what that is. That's exchange traded fund. I wondered, ETF versus like just a tracker OIC, and why one or the other?
I'm completely agnostic.
I wondered whether you had strong views on that.
Yeah, no. What are you trying to do? You're trying to get the cheapest, broadest exposure. Okay, that's tax efficient for you. ETFs are easy because you can buy and sell them like a regular stock, and through that you're buying and selling the underlying. In the old days, there were index funds, and they were. I mean, you don't actually have to go that far back, and still in some countries there are no real indices. There are no index trackers. Right. So keep in mind the difference between an index and an index tracker is like we can all agree what the FTSE is, but how do you go buy the FTSE? Someone has to create something you can actually go buy. Right? Yeah. That actually used to be a bigger deal. And then in some countries they might have an index, but there are all sorts of restrictions on buying securities in that country, so you can't actually go buy it. And good luck buying securities in Saudi Arabia. and so it's not, these access products are, ETFs have grown tremendously just because it's so easy. They're easy to create. They're easy to buy and sell. Yeah. Theoretically, if you had tons of money, you could create your own index. Think of it. What is an index? It's like you and I right now can decide to create an index of companies that had a CEO named Bob. That's an index. That is an index. It doesn't make any sense, but it's an index.
Yeah, sure.
But so it's clear that the access product is what's important here. Yeah. ETFs are a great thing. There's a reason they've grown a lot.
Yeah, sure. I know obviously this difference between physical and synthetic. In the book, you're fairly agnostic about that as well. Really. Yeah.
I think the world has gone physical.
Yeah. Why is that, do you think? Is it just because there's a sort of sense of security? I should just mention, this is a little bit the deep end of the pool, but a physical ETF will own the physical assets underneath a given index. So if it's FTSE 100 ETF, it will actually own FTSE 100 shares. Yeah, but a synthetic will come up with another way of tracking the market. So that's a fair summary?
Right, yeah. Now, the reason I think it's a simple one is I've started a charity, and I was in a meeting in this sort of complete aside, with a Kenyan-based reinsurance company, and they had some money to invest, and I said, go buy these ETFs, and I explained the difference between physical and synthetic, and the guy running it said, wait a minute, so you want me to go back and tell my board that I own something that I don't really own, but it's backed by collateral that may not be related? Wait, what? Like, nope, I'm not doing that.
Physical it is, yeah. Simple.
Physical it is. Stop talking, right? And so I was like, okay. And I'm like, if I was struggling to explain it to him, then so I think maybe, I mean, I'm sure the guy selling you synthetic can come up with a better explanation.
Sure. Yeah.
But it just sort of feels right.
Yeah.
You know, you buy something and that something owns what it says it owns.
Yeah. Yeah. There's a lot to be said for that. I think a lot of the ills in the financial services world is stuff being opaque, you know, and people getting involved in stuff they don't fully understand and being sold to. So
you can say that again. Yeah. That's the understatement of the day, right? Yeah.
For sure. Look, Lars, this has been a joy. I've really enjoyed talking to you. We could go on and on and on, but I'm conscious of your time and of the listeners. But obviously, the book is highly recommended, Investing Demystified, and Money Mavericks as well. I haven't read that one yet, but that's now on my list. And so where can folks find out more about you and what you're doing?
Well, if you know how, well, I don't know what I'm doing is that interesting, but if you know how to spell my surname, the publishers, there's actually a funny story. The publisher asked me to put together some videos explaining what I do. Yeah. And it was that simple. It's actually on the laptop I'm now doing this thing with. So I put some videos up on YouTube explaining these concepts, and they've gotten a ton of views. So if you know how to spell my surname, just bang that into YouTube, and there are a bunch of videos. I also have a website, which is Kroijer.com.
I'll make sure there's a link to that.
I don't really sell anything. That's what
No, absolutely. But I've watched those videos and they're super helpful. So I'll make sure there's links to all of this stuff.
I'll tell you, it's actually, I built this financial spreadsheet. It was kind of funny because I just built it as I was talking into the computer, and it's been viewed a ton. And It's in Excel. I'm a huge Excel nerd from my investment banking days, but you know, and if people have suggestions for what else, I'm totally open. I do this as a hobby. It's interesting, fun. I love the feedback. It's sort of, keep in mind, it's not often that you're someone with a hedge fund background and you feel you get to make a meaningful improvement in people's lives, and it feels really good, actually. I will say that. It
really does. Yeah, I feel the same. Lars, thank you so much for your time, sir. It's been a joy speaking to you.
No, pleasure. Thank you.